word. The world was told, for decades, that when America sneezes, the rest of the world catches a cold. But what if that old rule is breaking? What if, quietly and steadily, a new financial gravity is forming? Not in New York, not in Washington, but in cities like Jakarta, Mumbai, Sao Paulo, Nairobi, and Hanoi. What if the real story of this decade isn't about US volatility, but about emerging economies rising through it? This is KIYO Documentary, and today we explore a powerful shift in the global economic narrative, emerging economies shining despite US market turbulence. For much of modern financial history, the United States has been the anchor of the global system. The dominance of the US dollar, the influence of the Federal Reserve, and the performance of Wall Street have traditionally dictated global capital flows. When the Federal Reserve tightens monetary policy, emerging markets often suffer. When US bond yields rise, capital typically flows back to America. And when US stocks fall, global markets usually follow. But today, something different is happening. The US economy is experiencing waves of volatility, inflation concerns, interest rate uncertainty, geopolitical tensions, tech sector corrections, and fiscal debates have made American markets increasingly unpredictable. The S&P 500 fluctuates sharply, Treasury yields swing, the dollar strengthens and weakens within short cycles. Investors hesitate, risk appetite changes by the week. Yet, against this backdrop, several emerging economies are not collapsing, they are advancing. Take India. Over the last decade, India has transformed from a consumption-driven economy into a manufacturing and digital powerhouse, with aggressive infrastructure spending, production-linked incentive schemes, and a booming tech ecosystem. India has attracted billions in foreign direct investment. While US markets face volatility, India's domestic demand remains resilient, supported by a young population and expanding middle class. Then look at Vietnam. Once known primarily for agriculture and low-cost labor, Vietnam has positioned itself as a strategic manufacturing alternative amid global supply chain diversification, as companies reduce dependence on single-country production models. Vietnam has benefited from China Plus One strategies. Electronics, textiles, and semiconductor assembly have grown rapidly, making it one of Asia's fastest-growing export hubs. In Latin America, Brazil presents another compelling story. Commodity cycles have historically dictated Brazil's fortunes. But today, fiscal reforms, agricultural strength, and renewable energy investments are providing structural stability. But as global demand for food security and clean energy rises, Brazil's economic positioning strengthens even when US equities wobble. And in Africa, Kenya stands out as a fintech leader. Mobile money platforms, digital banking, and financial inclusion initiatives have allowed millions to participate in the formal economy. Innovation is not confined to Silicon Valley anymore. It is thriving in Nairobi's tech corridors. So, what explains this resilience? First, diversification of global capital flows. For For decades, emerging markets were highly sensitive to US monetary tightening. But today, sovereign wealth funds, regional investment blocs, and domestic pension systems play larger roles in financing growth. Capital is no longer solely dependent on Western inflows. Regional integration agreements and South-South trade are reshaping economic alliances. Second, stronger macroeconomic discipline. Many emerging economies learned painful lessons from past crises, from the Asian financial crisis to the global financial crisis. They strengthened foreign exchange reserves, improved central bank credibility, and adopted inflation-targeting frameworks. This has increased investor confidence even during external shocks. Third, demographics. The US, Europe, and Japan face aging populations. Meanwhile, emerging markets host the youngest populations in the world. A young workforce means expanding consumption, entrepreneurship, and labor supply. Over the next 2 decades, the majority of global workforce growth will come from emerging economies. But this transformation is not without risks. Currency volatility remains a challenge. When the dollar strengthens, emerging market currencies often weaken. Debt denominated in foreign currency can become expensive. Capital can still exit quickly during panic. Political instability, governance issues, and structural inequality remain significant concerns in many developing nations. Yet, despite these risks, investors are recalibrating their strategies. Global asset managers are increasing exposure to emerging market bonds and equities. Supply chains are diversifying beyond traditional hubs. Infrastructure investments are rising. Renewable energy projects are expanding across Latin America, Africa, and Southeast Asia. Another major factor reshaping this story is technology diffusion. Unlike previous industrial revolutions, digital infrastructure spreads rapidly. Smartphones, cloud computing, fintech platforms, and AI adoption do not require decades of heavy industry build-out. Emerging economies can leapfrog traditional development stages. Digital public infrastructure, such as payment systems and identity platforms, accelerates inclusion and efficiency. The rise of regional trade blocs also plays a role. Agreements across Asia, Africa, and Latin America reduce dependence on Western consumption markets. Cross-border commerce within emerging regions is expanding, cushioning them from fluctuations in US demand. Meanwhile, geopolitical fragmentation has unintentionally accelerated diversification. As tensions reshape global alliances, countries seek strategic autonomy in energy, technology, and manufacturing. This has opened opportunities for nations positioned between major power blocs. Yet one central question remains. Is this a temporary divergence or the beginning of a new economic order? Historically, emerging markets have experienced cycles of boom and bust. Optimism surges, capital floods in, vulnerabilities build, and then correction follows. The difference today may lie in structural reforms and domestic demand strength. Consumption in India alone rivals entire regional blocs. Urbanization across Africa continues rapidly. Southeast Asia's manufacturing sophistication increases yearly. Even global institutions are acknowledging this shift. The International Monetary Fund projects that a majority of global growth in the coming years will originate from emerging and developing economies. While advanced economies stabilize at modest rates, emerging regions contribute the bulk of expansion. And yet, the United States remains enormously influential. The dollar still dominates global reserves. U.S. financial markets remain the deepest and most liquid in the world. American innovation continues to shape global technology trends. Volatility in U.S. markets still reverberates internationally. But dependence is no longer absolute. We may be witnessing a transition from a unipolar financial world to a multipolar growth landscape. Not a replacement of the United States, but a rebalancing of influence. For investors, this demands strategic adaptation. Portfolio diversification now extends beyond developed markets. Currency exposure, regional ETFs, infrastructure funds, and frontier markets become increasingly relevant. Risk management must account for political cycles, commodity dynamics, and exchange rate movements. For policymakers in emerging economies, the challenge is sustainability. Growth must translate into employment, inequality reduction, and environmental resilience. Infrastructure must be financed responsibly. Debt must remain manageable. Governance must strengthen. For everyday citizens across these rising markets, the transformation brings opportunity, but also pressure. Rapid urbanization strains housing and public services. Digital economies disrupt traditional jobs. Inequality can widen if reforms are uneven. The next decade will test whether this emerging market resilience is structural or cyclical. Will India become a manufacturing giant rivaling established powers? Will Vietnam solidify its place in global electronics supply chains? Will Brazil leverage renewable energy to dominate green exports? Will Africa's demographic dividend translate into industrial transformation? Or will external shocks, policy missteps, and capital flight slow momentum? The answer will shape the global economy of 2030 and beyond. As U.S. markets navigate volatility, interest rate adjustments, fiscal debates, sector rotations, emerging economies are no longer passive observers. They are active participants, shaping their own narratives, building internal strength, and attracting global capital on their own terms. It is becoming multi-engine, and perhaps, just perhaps, the future of global growth will not depend solely on Wall Street's mood, but on the factories of Asia, the farms of Latin America, the fintech labs of Africa, and the young entrepreneurs building new economies from the ground up. This is not the end of American dominance. It is the rise of shared momentum, and as investors, policymakers, and citizens watch closely, one thing becomes clear. The story of global finance is being rewritten, not in silence, but in resilience. This is KIYO Documentary, where we decode the forces shaping tomorrow's economy.